Exciting updates have emerged from this year's annual Goldman Sachs Tech Conference. We engaged in discussions with leading CEOs to deliver the most recent and groundbreaking developments in the tech industry, from advancements in AI technology to our exclusive interviews. Here's a summary of the conference. Tune in for all of the details.
One of the biggest unknowns in the economy right now is what will happen to the U.S. consumer in 2024 as they try to navigate everything that the Fed has done as pertains to interest rates. Who better to ask what will happen to the consumer than Goldman Sachs Chief Economist Jan Hatzius. Jan, thanks for taking some time. Very busy tech conference here, and you are out of the chute with two big notes here today. First, lowering your recession odds to 15% from 20%. Why now with that move?
Basically because of continued improvement in the indicators of rebalancing. So the economy has continued to be pretty resilient. We're growing at 2% plus. We think that's going to be true in 2024 as well. Income growth looks supportive. Job growth is still pretty significant. And at the same time, the labor market has gotten more rebalanced. Job openings have come down, quits have come down, wage growth decelerated. You saw that in Friday's numbers in the employment report. And inflation has come down. So I think there's increased evidence that we can see rebalancing of the economy, inflation coming under control, and it's not going to require a recession. So we've progressively reduced our recession probability. We had it in the 30%, 35% range around March when you had the financial turbulence and the banking turbulence. Always thought that it was less likely than 50%, but I've gotten incrementally more confident that recession can be avoided.
Does this quantify as a soft landing for the economy?
Yes. In fact, the note that I published yesterday, I titled it Soft Landing Summer, because the evidence that has accumulated, especially over the last few months, is very much consistent with soft landing.
A lot of folks that have been reading this note and consuming it on the Yahoo Finance platform seem to be asking this question: what's the impact of the Federal Reserve's rate hikes? Doesn't that hurt growth at some point?
Well, I think it has hurt growth. They've hiked the funds rate by 525 basis points. That did reduce growth in the past year, we think to the tune of as much as 1.5 to 2 percentage points in the second half of last year. But the lags of monetary policy, according to our analysis, are relatively short. And the biggest impact of this of these rate increases now is behind us. And we can see that, for example, in our financial conditions index, which actually has been easing on net since the October of last year. That's almost a year of net easing. So if financial conditions are easing, it's sort of hard to say that monetary policy is having a large negative impact on growth right this minute. We think it's diminishing, and we think the impact is going to continue to diminish, assuming that we're now either at the end of the rate hikes or almost at the end of the rate hikes. And we think we're actually at the end of the rate.
So you're not are you in the camp where no more rate hikes at the next Fed meeting? They're done for this cycle.
Next Fed meeting in a couple of weeks, highly unlikely that they hike. I think that's already been pretty clearly signaled. Beyond that, I think it's possible that you get another hike, but it's not our expectation.
Would a part of that hike be a function of, we're now seeing oil prices back to $90 a barrel. We're seeing food prices as a result pick back up in many places. How concerned are you about this disinflationary narrative becoming inflationary again next year?
Well, I think headline inflation, of course, depends to a significant degree on what happens to commodity prices. So increases in commodity prices will be visible in terms of headline inflation. The real concern, though, from the Fed's perspective, has been core inflation, underlying inflation getting entrenched in the economy. And I think there, the news flow has been very positive. It's been positive in terms of the core inflation indices. It's been positive in terms of the labor market rebalancing. It's been positive in terms of supply chain disruptions disappearing. So none of that is really being called into question by the commodity price rebound. although, of course, commodity prices matter for headline.
How tough will it be for the U.S. economy to withstand the restart of student loan payments, and where do you fall in that debate?
We do think that that's going to be, a modest drag on growth in the fourth quarter, maybe in the first quarter. It's going to take a few tenths of the increase in real consumer spending. We do think that Q3, where we're estimating almost 3% quarter-on-quarter growth, and other estimates are even higher than that, that's probably going to be sort of a local high. Fourth quarter, we think, is going to be lower than that, maybe closer to 1% than to 2%. But I don't think it's going to be a long-lasting or deep slowdown. We think it's going to be, in the end, something that keeps us at a trend or slightly below trend pace. But in 2024, we expect a reacceleration to about 2%.
The other note you wrote that U.S. consumers will likely outperform in 2024. And I think that might be the contrarian view on the street, depending who you talk to. Why are you so confident in the consumer here? We have seen a lot of retailers, Macy's, you name it, warn about rising delinquencies and people not being able to pay their bills.
I mean, at a macro level, if there was only one indicator that I could know regarding the consumer, it would be real disposable household income. And that has been growing at a 4% pace in 2023. We think 2024 is going to be a little weaker, but we're still expecting about 3% real disposable household income growth. If that's right, or even if that's anywhere close to right, then it's very difficult to see declines in real consumer spending. And in fact, we're expecting continued moderate growth. Now, that's at the most macro level. Of course, you can drill down into the different income groups, the different types of households, the demographics. And I would agree that probably a bit more of that growth is going to be towards the top end of the income distribution. And the bottom end of the income distribution, I would expect to be somewhat softer. And I think that would be consistent also with some of the things that we've seen on delinquencies among lower income consumers. That said, we're still expecting income to grow for low-end consumers. We expect real wages to grow, and we don't think that there will be a large deterioration. But incrementally, it's probably going to be a little bit softer than in the macro numbers.
Within your outlook for next year, in terms of monthly job creation, are we still over 100,000 jobs created each month? And where do you see the unemployment rate going?
In the next year, we still think 100,000 or a little bit more than 100,000. There is a deceleration in job growth. Job growth is normalizing from the really outsized rates that we saw coming out of the pandemic. But yeah, we think it's going to be a gentle decline. Again, this is going to, of course, depend on how the overall economy does. What happens to GDP? If GDP grows, 2% or so next year, then I think you can be pretty confident that we'll also continue to create a decent number of jobs, 100,000, 125,000, 150,000. And I think there are good reasons, including the income point I just made, to expect that growth is still reasonable. In terms of unemployment rate, we're expecting more of the same, meaning about 3.5%. We're at 3.6% for the end of next year. We saw a 0.3 percentage point increase in the unemployment rate in August in Friday's employment report. However, that was entirely driven by an increase in labor supply, so it's not a concern. Normally, if you'd ask me if you saw a 0.3 percentage point increase in the unemployment rate, I might say it's a little concerning. But if you dig into the details and look at layoffs, still very low, but increases in the labor supply, that is something that is, I think, reassuring. So no real change. We've been in the sub 4% range for unemployment since early 2022, and we still expect to be there next.
Jan Hatzius, Chief Economist at Goldman Sachs, always great to get some time at this conference, and always a pleasure to read your team's research, some of the best in the game.
Thank you so much. Wonderful to be here.
Lots of talk about AI, the future of AI, and what it means to the stocks in the tech space. Joining me now is Zoom CFO Kelly Steckelberg. Kelly, good to see you in person for a change.
Hi, Brian. Yes, it's great to finally meet you.
Thanks for joining us. So we actually heard a presentation by your CEO a little earlier on, about an hour and a half ago, about how he wants to grow the company 4 times. How do you get there?
Yeah. So there are lots of exciting initiatives that can help us accomplish that. Of course, there's Zoom Phone, which is our cloud PBX solution, which has had great momentum. We announced on our call last week. It's crossed over that $500 million run rate of revenue, so that's really exciting.
That's a big number.
Yeah.
I remember when you first launched Zoom Phone.
Yeah, it's like about 5 years old, so it's gotten there really quickly. So yeah, very, very exciting. Lots of continued momentum there. We have Zoom Contact Center, which is our cloud-based contact center, natively built from the ground up, seamlessly integrates with voice, with video. And we announced on our call, we have over 500 customers there. That's only 6 quarters old. So that's still, maturing into its own. And then, of course, there's lots of interesting discussion we can have around AI. So we announced just this morning Zoom AI Companion, which is our answer to how generative AI is going to be included in our platform. And there's all kinds of really cool features that come with that for our paid subscribers. There are things like Chat Compose, if you're in a chat thread and you want to be able to respond to that. There are things like meeting summaries, which after the fact help categorize and capture not only what happened in the meeting, but also the true sentiment. It's not like reading a whole transcript of the meeting. It really
Well, people know that I'm in the meeting. I don't want to go into any more meetings. Kelly, will there be a light that goes off? Brian was here, but maybe not here?
No, we're not going to do that for you. But you will, if you're not there, you don't have to call yourself out by asking your colleague to catch you up, right? You can just read the meeting summary.
So AI is being used for paying subscribers. How do you bring that down to the free user base?
Well, we want to use this as a way to motivate them to convert, right? I mean, there's lots of value you get in our free platform already, but this is one way you'll continue to see that differentiation between paid and free. You've already seen some of that over the last year where we added the 40-minute limit, for example, and this is just going to bring more and more value to our paid subscribers and really help people see that it makes sense to have this as a part of your daily workstation and not have to be constrained by any of the free lack of functionality you might get on the free side.
When do these changes start? Will I be able to flip on Zoom in a couple days and poof, they're all on there?
Yes, there are certain aspects of it that are already generally available, parts of it that are in free trial modes right now. But yes, I would say the next time you upgrade your Zoom client, you're going to start to see some of these features.
There's been different approaches in C-suites on how to factor in AI into their guidance and their outlooks. When I hear you say we're putting AI features for paying subscribers, does that change the earnings output of the business for next year?
Well, we actually also have components of our platform that are really powered by AI that are standalone SKUs. For example, we have Zoom Virtual Agent, which sits beside our contact center solution. It was really powered by our recent acquisition of Sozzi, accelerated the development of that product. And it's exactly what it sounds like. It's a virtual agent that can respond to simple queries. Like we use it internally for our customers, and it's been amazingly effective at things like I need to reset my password. And so that is a standalone SKU, which is driving revenue for us today. We also have things like our translation SKU, which is also powered by AI, that is a standalone SKU that paying customers pay for. So there's going to be a mix of things that you get as kind of table stakes of the platform as a paying customer, and then additional SKUs that we monetize.
I feel the enthusiasm, Kelly, in this room on AI. I've been here 4 or 5 hours already, and it's bursting at the seams. Is it hard to manage investor expectations given the hype we are seeing around this technology?
I think that the hype was super high, and it is really exciting here, but I think it's kind of coming into a sense of reality now that people are coming into grips, and sort of there were unfounded fears, I think, in certain aspects of AI is going to potentially diminish the aspects of certain companies' effectiveness. And we see it the opposite, right? What it's going to do is it's going to make us all more efficient and enable us to do the things that we really love or that are really value add. And that's why, again, parts of it are table stakes in the Zoom platform so that all of our customers get the benefit of that.
There's also been some chatter in the early panels about, let's say, the yawning influence of a competitor like Microsoft. How do you view them? Are they increasingly encroaching on your turf with Teams?
Microsoft is a great partner and a great competitor of ours. We certainly never take them for granted, but we also listen to our customers, and our customers, they love Zoom. They want to use many parts of the Zoom platform, and sometimes potentially in conjunction with Microsoft. So we have seamless, natively built integrations with the Microsoft platform where you can one-click, for example, launch a Zoom meeting from the Microsoft interface. And that allows our customers to leverage the platforms in ways that serve them best.
What's the health of the small business customer?
Small business is really interesting. It's where Zoom really started. It's at the core of our roots. And we saw great performance out of our mid-market teams in Q2. They were really, I think they've rebounded, if you will, from some of the changes that we made earlier this year internally. And that makes sense. Like, those sales cycles are shorter. They've gotten back into their territories and they're doing really, really well. So that continues to be a place also that we differentiate ourselves from some of our competitors.
Early on, I had the chance to catch up with Goldman Sachs Chief Economist Jan Hatzius, and we talked a lot about the health of the consumer right now, but into 2024. Jan is pretty upbeat and optimistic on the consumer outlook. But do you see that same optimism in small businesses?
Yeah, we do. Again, we saw the strongest performance in Q2 out of that mid-market segment of our business, and strong pipeline coming into Q3. So they have been, I think, a little bit less impacted by some of the downsizing we saw earlier this year. And something like Zoom Contact Center is perfect for them, right? Because it's natively built into our platform. It's simpler to integrate than potentially some of the competitors. And so those are the types of customers that don't have huge IT organizations. They're self-serving themselves. And so having a Zoom platform for them makes a whole lot of sense.
Lastly, before we let you go, I'm putting this question to every leader we talk to at this conference. What is your biggest challenge for next year? Maybe not necessarily just from a Zoom perspective, but from a leadership perspective as well.
I think as we go into next year, there's obviously a huge demand for talent around, especially AI, that everybody's focused on. We are really lucky. We've had some amazing leaders join us recently. XD Huang joined us. He's joined us as our CTO. He was formerly from Azure, and he's been great. So having great talent like that begets great talent. So I think that's going to really benefit us as we move into next year. But I think it's returning the company to accelerated growth. That's what we're really focused on in everything that we do.
All right, well, good luck at the rest of the conference. Zoom CFO Kelly Steckelberg, good to see you as always. We appreciate it.
Thank you, Brian.
Mr. Secretary, always nice to get some time with you here. So we're done with the summer, getting ready into the fall travel season. But before we even start our fall travel, we had news this week about United Airlines having trouble or computer glitches or whatever it might have happened there. Have you talked to United Airlines, and do you think that is indicative of airlines underinvesting in their platforms?
Well, you never want to generalize too much from one case, but this is not the first time this year that we've heard about the technology issue, the issue that we saw earlier at Southwest Airlines. We had an issue with the FAA. So clearly, in terms of keeping the aviation system operating smoothly with the pressure that it's under, there's going to need to be continued attention to technology. I did speak to the United Airlines CEO yesterday as the situation was developing. They were able to get on top of it pretty quickly and get service back to normal. But certainly, I think points to the role that technology increasingly plays, not just the onboard technology. And of course, we spend a lot of attention here at the department certifying and looking after the safety of aircraft technology itself, but everything around that, from dispatch systems that airlines use for their operations to the various communication systems that the FAA uses for ours. And of course, across all of that, our top priority is always going to be safety. And then once safety is seen to, you got to make sure that the operations are looked after. But the good news is, overall, you look across the Labor Day weekend, at the end of a summer that saw an all-time record high in terms of the number of Americans getting onto airplanes, we saw less than 1% of flights canceled, less than 2% of flights delayed. We're not satisfied or sitting back, resting comfortably, but very encouraged by the results that we saw that holiday weekend and generally speaking over the course of the summer.
These tech delays, Mr. Secretary, that seemingly come out of nowhere, should flyers just expect these things to happen this fall and even into next year as technology plays a greater role in our lives?
Well, the big thing I want flyers to know is that when there's a situation that an airline is responsible for, and certainly a mechanical failure or an IT failure delaying or canceling your flight is an example of that, you have recourse. We are enforcing customer service agreements that are dramatically improved compared to where they were just a year and a half ago after everything passengers went through last summer and the pressure that we put on airlines. So we're encouraging passengers to go to flightrights.gov so you understand if you do get stuck in a situation like that an airline is responsible for, what you can expect and what you can be guaranteed in terms of coverage for how you get rebooked, having your expenses covered while you're on the ground, meals, hotels, that kind of thing. The best scenario, of course, is for that kind of disruption not to happen in the first place. When it does happen, we want to make sure passengers know that our department has your back.
The New York Times recently reported, Mr. Secretary, close calls or an increasing number of close calls on the tarmac. Why do you think this is happening? You know, we haven't had a major aviation disaster in some time, but I think consumers seeing these stories are like, wow, what's going on here and what can be done to prevent something catastrophic from happening?
Well, a lot goes into maintaining the safety record of our airspace. We have the safest, most complex aviation system in the world. Amazingly, flying is actually the safest form of travel by far in the United States. But we don't take that for granted or sit back with that, which is why now, even a situation that was out of the norm, let alone an actual incident, is going to get the kind of attention that used to be reserved for when there was an actual collision in the past, something that hasn't happened in over a decade in the United States. And again, lots of work goes into keeping it that way. Keeping it that way for the future includes making sure we have the right kind of technology. It means making sure that there's the right kind of training and attention. We're pushing a lot right now on situational awareness, communications, sterile cockpits, good hygiene that everybody, whether in the tower or in the flight deck, needs to maintain. The other thing I would add is that what would not help us in the progress we're making right now is a government shutdown. You know, this is a very good and important example of why non-defense spending in the federal budget is very important. If we went through a shutdown, a lot of the progress that we have been making on building up air traffic control staffing and readiness and training would be stopped in its tracks. We would lose the momentum that we've gained over recent weeks and months, and it would send us in the wrong direction. So one of many, many reasons we're looking to Congress to do what it takes to fund the FAA, fund the government, and keep things moving.
There has been some chatter on the other side of the aisle, the Republican side. Maybe they should push for a government shutdown. Just from your vantage point, how terrible would that be for the U.S. economy? You're talking about, you know, flights being ground to a halt potentially, and a lot of other things that could be really damaging.
Look, this would be a mess for the U.S. economy. Even if they keep the bare minimum up and running in terms of having the air traffic control towers open, we would lose the trainees who are part of the operation there. A shutdown, even lasting a few days or a week, could set us back by months in terms of the training pipeline for controllers because of everything that goes into building that kind of experience and keeping it current. So you look at aviation, which is in the neighborhood of 5% of our GDP, that alone would be dealt a really serious blow to the momentum that we've been seeing from a shutdown. It's one of many, many examples why this is not, you know, they're playing with live fire here. This is not theoretical. This is not academic. This is direct damage to the U.S. economy that can and in our view must be avoided and be prevented. I don't think there's any justification for playing political games with something as important to our economy and as important to our economic and national security as keeping the federal government up and running and serving the American people.
And lastly, Mr. Secretary, I know this doesn't fall under your direct purview, but we're at a pretty interesting moment in the UAW negotiations with the major automakers. If an agreement isn't reached and these workers go on strike, maybe that's one less car produced. Maybe one person won't be able to get to work. What do you think that does to our economy? And does it feel like a very big moment for the labor movement in this country?
I think the moment you're seeing with the labor movement is a recognition that there are big changes and developments coming to the auto industry, and the UAW wants to make sure that workers benefit from those changes. Look, I grew up in a town that was shaped not just by the auto industry generally, but by the achievements of the UAW specifically. We're the hometown to Local 5 and Local 9 back in South Bend. And so I've seen directly how the middle class and the prosperity of whole communities is shaped by the ability of auto workers to get a fair share of the wealth that they create. Now, of course, they need to be at the table working with the auto companies that have a business to run and need to make sure that sector succeeds. And so our role has been engaging the parties and urging them to come to a negotiated solution that spares the American economy the impact of a strike, and that also ensures that workers do right by the extraordinary opportunity in front of us. You know, not that long ago, a few years ago, we were talking about a manufacturing recession here in the United States. Now we're seeing a manufacturing job boom. I was just back in Indiana where I grew up and drove the road from South Bend to Indianapolis past a massive facility under construction outside of Kokomo that is just one example of the auto supply chain and industry construction and development happening right now. We need to make sure we keep the momentum for that economic manufacturing growth and, as the UAW is seeking to ensure, have that development happen in a way that benefits American workers.
Transportation Secretary Pete Buttigieg, always great to get some time with you. Thank you for talking about a lot of really important issues with Yahoo Finance all the time. Thank you so much.
Same here. Always good to be with you. Thanks.
The biggest cell phone providers in this country have descended on this conference as well. Talk about what they're up to right now and ahead of next year. Joining me now is AT&T CEO John Stankey. John, good to see you again.
Brian, good to be here.
So you're here to tell me that the future is drones, right?
It's certainly one part of the future, yeah.
So talk to us. What is this? Why is it here? It's for those who might be watching this right now, it's a giant drone. You know, why does AT&T have this in its arsenal?
Well, over 6 years ago, we started a public-private partnership with the government to create a first responders network called FirstNet that ensures that any first responder can get data communications whenever they need to in a time of crisis. Could be a hurricane, could be a fire like in Maui. We had to come up with a lot of different creative ways to meet the needs. And so we've got cell sites that show up on trucks. We have cell sites that show up in suitcases. We have cell sites that float around on blimps. And we have cell sites that we can put up in the air on a drone.
These are a little scary.
Yeah.
I like sitting next to these. The remote's not here. So these are not.
No, they're not going to turn it on, hopefully.
Yeah, I want to get asked back to the Goldman Conference.
But this is a good example of when we're in a pinch and we don't have a cell site or it's been taken out by a disaster, we can put temporary service up and get people communicating so that they can save lives and do all the things that they're supposed to do. And we've done a really nice job working with public safety to meet their needs. And we have a great, not only infrastructure that supports it, but a great services organization that's always on the spot helping them out in a time of crisis.
You know, part of your role is thinking many years in advance and putting initiatives in the ground today to bear fruit at some point in the future. Look at all the climate events we're having in the U.S. and around the world. Is this a business that you want to expand? Should there be more drones out there? And how will you be using these in future?
Well, it's been a really good business for us. We were underpenetrated in the public sector before we started this effort. We've now got 5 million devices that we've sold into various agencies and first responder entities that, you know, it's good business for us around that. And it's a great way to keep people communicating as well. But you step back, a relationship of 26,000 first responder agencies is a big deal for us. Drones, we'll do whatever we need to do to keep them happy and on the network.
You know, I was joking with you a little bit off camera. This feels like a deja vu moment. We were just here 1 year ago, and at that time, you had just sold off your media assets, and now it seems like you're a different business. Where are you at in terms of transforming AT&T?
Well, we're real pleased with where we're at. To your point, we've gotten a lot of the structural transaction work done. And we're now focused on being the best communications provider there is. And we're not there yet, but we're certainly working our way toward it. And while we've gotten the structural deal transactions done, I think a lot of credit goes to the team and what they've been able to achieve and execute during that period of time. You know, over the last 3 years, over 8 million new postpaid cell phone subscribers. We've seen over 3 million broadband fiber subscribers that have come on the network. Our service indexes, either rated by external agencies like ACSI or JD Power, as well as our own internal customer service metrics have all improved. We've been able to generate more cash yield out of our business that you started to see in our quarterly results. That's good execution. And the team's done a really nice job of not only getting the transactions done, but getting the focus back on operating the business soundly. Our wireless business at the time that I took over had some gaps between us and the performance of some of the better, run companies in the industry. We've closed most of those gaps on margin, churn, revenue performance, and really pleased with the progress that the team's made in those areas.
We've been hearing murmurs recently about renewed competition price-wise for cell phones in terms of monthly bills. What's your take on the situation, and are you ready to get more competitive on price?
Well, look, we've been in a competitive industry for a very long time, and we still are. And we're offering, frankly, more value to a customer than ever before. If you look at the speeds that we're able to provide a customer, the utility that a wireless device gives somebody in their everyday life, the ability to use devices now as hotspots so that you can tether your laptop or your tablet with you when you go. Those are all great things. And customers are using 35, 40% more of the service a year ago than what they're used last year. And so that's a big deal. And when we do that, I think what we're able to do is drive value and sustain pricing. So I think our plans are incredibly competitive, especially when somebody buys into a family and has 3, 4 devices on an account. I think we're incredibly competitive today, and the industry is actually working on adding more value. And you see ARPU's improving, meaning the customer is paying us a little bit more. You see people staying with us longer. They're not churning off as fast, which is a sign of satisfaction. And you see us growing the business. Over $1 billion of incremental operational cash flow in the first 6 months of this year than last year. That's a good formula.
There a lot of low-income households continue to struggle. We hear from the likes of a Macy's and Nordstrom. People are not paying their bills on time, credit cards, you name it. Are you seeing that with your monthly payments? Or consumers saying, you know what, I just can't make that payment this month for the cell phone?
Well, look, we have a high-quality customer base to begin with. And so it doesn't surprise me that maybe we were a little bit insulated from parts of the market that might be more value-oriented. But I think you should also step back and realize the government's done a nice job of putting support in place for people to have these critical communications devices. So the ACP program that provides $30 of subsidy a month, those people that are really in the position that you just articulated can apply for that government support. And we offer discount programs that match that. So broadband 100 by 100 service, $30 a month, $30 of subsidy from the government effectively makes that free. Similar in our cell phone business, we have certain programs that we offer into low-income communities that allow them to take advantage of that subsidy. And as a result of that, we don't see that kind of problem popping up right now. And I think part of it is not only the reasonableness and the value of the product and the subsidy that comes with it, but it's kind of like air. You need to have your communications to get through your day, right?
Yeah, and I need my phone.
Yeah, so I think maybe there's lower priority things that may be the ones that are on the chopping block before a communication.
Right, so we're not buying that extra pair of socks, but we continue to pay for our bill. Okay, check done. Now, key to your turnaround is you've been able to cut out a lot of cost from your business. Can you give us a number on how much, in terms of cost savings in your model, there is left looking out over the next few years?
Well, we've taken $6 billion out of our run rate over the last 3 years or so, which is really good work by the team, and that's particularly impressive given it was done in an inflationary time period. We've just recently stated we're going to do another $2 billion, and I feel really comfortable about that. We're a big business. We have a lot of opportunity to manage costs. We're in the middle of a transition like many other companies are, a combination of new technologies like fiber and 5G that customers love. We have some technologies that were great for the last 40 years, but they've now served their purpose. And as we start to shed those products and services, costs come out associated with that. We're using technology like anybody else. Our ability to apply AI into our business to handle customer inquiries effectively, to do it both digitally online and in call centers where a customer doesn't actually have to speak with somebody to resolve their problem, to do our engineering better, to write code in our software organizations more effectively. That's taking costs out. So we have a lot of places we can go to run our business more effectively.
One more for you before I let you go. If you go to Yahoo Finance, you go to the AT&T ticker page, you'll see that the stock is yielding like 8%. Does that surprise you? And what's your message to investors that are looking at AT&T or looking at a treasury? Where do you go?
Yeah, it disappoints me. It disappoints me that maybe folks aren't willing to bid the stock up to what I think is the fair value, but I think I'm pretty pragmatic about it. And I think what's going on right now, as we just talked about, we're repositioning the business, doing a lot different. We're coming out of major transactions, and there's a little bit of a wait and see. We need to do what we say we're going to do and do it consistently. When we do that, if we remove some of these other exogenous things that are going on, like what we see happening with the controversy over lead cable that we believe is not accurately represented in terms of what the exposure is.
Looking into that.
Then
clear.
Yeah, then the business will perform and ultimately be valued fairly. And I'm comfortable that will happen. And we just need to every day come in, run it well, do our best, and eventually the market will find the inherent value.
Joining me now is T-Mobile CEO Mike Sievert. Mike, I've talked to you from a kitchen table in the middle of a pandemic, a couple weeks ago in a hotel room, and finally in person.
Well, thanks for coming all the way out to San Francisco, Sozzi. You look like New York, though.
Well, I look great. It's good. It was the suit, right? So talk to us about, Shauna just mentioned on the other side, about the new dividend, about the new stock buyback. What's your message to investors having pulled the trigger on both those things?
I think what investors expect from us is ongoing, reliable growth. Profitable growth that translates into industry-leading cash flow growth. And that's what we deliver. And we've been delivering it consistently over time, such that we believe it's time to make the next installment of our long-standing aspirations around shareholder remuneration. And in 2021, we laid out an aspiration that was big and bold, that we saw up to $60 billion in shareholder returns during our planning horizon. And this is the second installment, $19 billion over the next 5 quarters. And as a part of that, our first ever dividend, a $3 billion annual dividend. That's $3.75 billion over the 5 quarters that we see increasing at about 10% a year within our much larger cash flow envelope of outlooking something like $16 to $18 billion next year.
Don't run off the set when I ask you this. Don't pull off the mic, because when I think telecom, dividend payer, I'm thinking potentially slower growth. Do you see, is T-Mobile now a stodgy telecom company? Because I think a lot of investors on our platform only know you for strong earnings growth.
Far from pulling off the microphone. That's a really important question. And look, we are outperforming this whole sector on growth, and our capital priorities have not changed. It is to fund this historically great business plan, and both organic, inorganic, core business, as well as adjacencies. Secondly, to get our business on the stable footing of a leverage around 2.5 times. About mid-2s has been our long-term leverage aspiration. And we're going to move there next year because of the wider rate environment. We think it's smart to move there a little faster than planned. And third, to return all that massive cash production to shareholders. And it's time for us to start doing that in a more evergreen, reliable format, because those cash flows are now evergreen and reliable. And it's a big moment for our company.
So T-Mobile, still a double-digit earnings grower.
Well, listen, last quarter, to put it concisely, was the biggest postpaid net addition quarter in 8 years, and tied for the biggest in our history for a Q2. That's huge. And we translated that into industry-leading service revenue growth at the consolidated level, as well as postpaid wireless, the stock you buy and the place where all the value is created. And we translated that into double-digit EBITDA growth, highest in the industry, and then translated that into the highest cash production in the industry, not just in terms of overall growth, outlooking 75% year-over-year free cash flow growth this year, but in terms of cash production per revenue dollar. We'll be north of 20% cash flow margins as a percentage of service revenue this year, best in the industry by far, and only going in one direction.
Fair enough. Are there cost savings left from the Sprint acquisition?
Yes, we're at a run rate synergy of around $7 billion out of $7.5 billion. We see a little bit more room to clean that up. But really, from here, it's about executing our business plan. And after 3.5 years of integrating our business, we have a fantastic company that's really performing, but we have to make sure that we're our best version of ourselves. And we've been making changes to make sure that we're not just successful this year, we're successful 3 years from now. Some of those changes are a little difficult. We had to execute a reduction in force this month, but that's to make sure that our company is super successful 3 years from now, and that we're able to be the best version of ourselves, fast and nimble, competitive, entrepreneurial, the kinds of cultural traits that created this success in the first place.
Investors that have jumped aboard the T-Mobile growth story all these years under John Legere, now you, of course, the CEO, John, of course, the former CEO, they're not used to seeing layoffs, Mike. I think this is something that came as a surprise to a lot of investors.
Yeah.
Did you feel pressure to do it, and are you done doing
Well,
it?
it wasn't a decision we took lightly because this is not a normal thing for a company like ours. We wanted to do it in such a way that it really was about the people who are staying, which are the vast majority of employees. Every employee deserves to know that they are working on something important, that their role's not duplicative, that they work within a management structure that's fast, efficient, and decisive, allows them to get their work done so that we can really execute in what is a really competitive environment. And that means being very efficient. So yeah, we told employees in my letter to them, we were doing this now, and we want every employee that's staying, which is the vast majority, to know, that this is going to be a better place to work and that there isn't another shoe to fall.
You mentioned competition. We have heard recently, the past few weeks, more price competition from the cell phone carriers. Are we going back to new price wars, or is that just a thing of the past?
No, it's just that the nature of the competition keeps changing. Now, we did bring extra competition, just like we promised we would when we created this merger, and it's more competitive now than it was a few quarters ago, mostly due to the dynamics of our merger. But the nature of it is what's changing. Right now, customers want a fantastic deal on a smartphone. Those smartphones have gotten a lot more expensive, and they're now relying on the carriers to help them afford those. And so that's where the nature of a lot of the competition has gone. But on the other hand, they're willing to pay up on the rate plan side to get some of those smartphone subsidy benefits. And so, the nature of it keeps changing. What makes us distinguished is we're guided by customers. We just keep listening to customers and changing how we execute so that we're always able to deliver an overall better value. Because ultimately, post-merger, what customers expect from us is the best network, backed by the best 5G and the best asset portfolio, and the best value, backed by the best balance sheet. And we're the only ones that can give them both.
Is there any cell phone bill relief coming at all at any point, or do you just have unlimited pricing power because we need our phone? I'm not getting rid of my phone.
Well, quite to the contrary, this has been a massively deflationary market over the years. What customers get for what they pay now is better than ever. And wireless has been one of those sectors that has been contra to the inflationary trend where a per unit pricing against consumption in wireless is the best now that it's ever been. And by the way, we spend tens of billions of dollars to build these historically great networks, and yet translate that with a better value over time to customers and still deliver cash flow aspirations in line with our expectations. So, we have to thread the needle against all these stakeholders, and so far it's working beautifully.
Last 15 seconds, you excited about the new iPhone?
Absolutely, we always are this time of year. Can't wait to see what they come out with.
All right, me too, I'm about due for a new iPhone. Mike Sievert, T-Mobile CEO, thanks for making time for us. It's a very busy conference. It's lunchtime, let's go eat some food.
Yeah, glad you guys are here, Sozzi.
All right, appreciate it. And joining me now is Eric Sheridan, Managing Director at Goldman Sachs. Eric, thank you for having me to the conference. Again, really enjoy being here. And you cover a lot of the companies that the Yahoo finance community follows religiously and they love. But before I get into some of these tickers, what is the appetite to own some of these big cap tech stocks, given the runs they have seen this year? And in many respects, they're trading on peak multiples.
Yeah, I think it depends on the name, but generally I think there is a view that owning large-scaled technology companies that are going to produce compounded returns is an area of focus in the market right now. So of all the companies I cover, I would say investors are playing offense on all of those names. But among the larger names, especially the ones that can be valued on GAAP earnings, the Metas of the world, the Alphabets of the world, there is an increased focus of being able to buy compounders at reasonable valuations against earnings power. And then you have the emerging players like Amazon and Uber that are large-scale players, but are still in the process of growing into their GAAP earnings. And that's attracting a certain type of investor that's interested in growth at sort of a rising profitability narrative. And I think those are the two interplays we get in terms of talking to investors.
When you talk to investors, are they worried about what the Federal Reserve does? Because the thinking is higher rates, bad for tech stocks. And if the Fed is out there next year raising rates, tech stocks, maybe they don't do well.
Well, I think we went through a process of investors absorbing higher rates for longer at the end of last year and the first half of this year, and you saw a very aggressive reset of valuations in technology in the second half of 2022. We think that reset has mostly happened at this point, unless there is a change that 5% rates plus or minus are going to be the new normal. If we end up with higher rates than that, we'll have to go through another valuation reset probably for the broader group. But our house view, and Jan Hatzius, our chief economist, was here yesterday from Goldman Sachs, would be that the recession probability is coming down and the Fed is unlikely to raise rates anytime soon in the next couple of meetings. So that's our Goldman Sachs house view as published by Jan.
All right, let's go into some of your companies that you cover. Let's start on Amazon, because folks on our platform are waking to news that maybe Amazon is broken up. There's a lot of concerns about what the FTC does to Amazon or doesn't do. Do you think Amazon gets broken up, and what does it mean to that stock?
We still put a low probability on that. We do use a bit of a sum of the parts valuation in terms of looking at Amazon, because Amazon is in very different businesses. Historically, we have written that we don't see any antitrust concerns between the consumer business and the cloud computing business. Without knowing what the FTC is going to allege, the press is reporting that some of it is around behavior inside their e-commerce business, the way they use the Prime subscription to incent behavior on the consumer side, and the way in which their third-party seller business interacts with their first-party seller business. Without knowing the details, it's tough to know exactly what they're going to allege. But those are some of the examples of areas we think they're going to examine and continue to examine from an antitrust standpoint. We do highlight, though, that Amazon still is a relatively small percentage of overall retail sales in the United States, and still a much lower percentage than that outside of the United States. So still a long way to go on e-commerce penetration.
Does this issue, though, hang over that Amazon multiple like a black cloud?
Look, anytime something regulatory comes into the headline, it's going to be an overhang. I will tell you, until this lawsuit probably gets filed, the next 3 weeks will be investors asking me, what do you think is going to be in it? What do you think the potential outcomes are?
I'm warming you up here for those questions, Eric.
Exactly. Okay. And unfortunately, folks like myself won't know until we see it. So that, in effect, I agree with your hypothesis, that will act as an overhang over the next couple of weeks, probably.
Fair enough. Another name you cover, buy rated on Meta. It has been a big year for this company. The stock has gone through the roof. You have had Meta really drill down on costs. The street likes it. The top line has started to improve. What does next year hold for this stock and also a company like Meta?
Yeah, so they're still in the process of going from some of the consumption shifts we saw towards short form video, messaging, and other platforms now to being monetized. So you're seeing that reacceleration of revenue at Meta. We think you're going to continue to see revenue reacceleration all the way through the end of this year into the beginning part of next year. That's the first catalyst on Meta. Second is, while this is the year of efficiency on costs, as talked about by the CFO, Susan Lee, and by Mark Zuckerberg, you're still going to see the benefits of incremental operating margins next year, not just this year. So we would tell you you're still going to see earnings momentum. The third is going to be an interesting catalyst. At the end of this month, they're holding their Connect event, and we expect Meta to put on display a couple things. The output of some of their AI efforts and how they might be consumer and user facing going forward, and some of the metaverse initiatives that have been a big drag on profitability and a lot of the losses as they break that segment out. But now you're going to see some of the products, which sets up for an interesting dynamic next year for technology. You're going to continue to see Meta putting out virtual and augmented reality products under the Quest brand, and you're going to see Apple launching their Vision Pro product early next year as well, which sets up as an interesting product dynamic for technology into 2024.
Some would say Meta's revival this year has come in part because of what's happening over Twitter/X or X/Twitter, whatever it is. Is Twitter just a non-factor at this point in social media? And then do you crunch the numbers on what a company like that is worth? Do you even go through that exercise anymore?
We typically don't value private companies. We haven't valued or talked about that for Twitter since it was acquired by Elon Musk. Twitter, though we have written in a number of our research reports as we've done work on the advertising sector quarter in and quarter out, Twitter has been a share donee of ad dollars. We've written about their ad revenue, even though they're a private company, being down 50 to 60% year on year. That's about $2 to $2.5 billion of dollars donated back into the broader advertising landscape. But that in and of itself is not why Meta is reaccelerating. It's really elements about unlocking revenue potential in short form video and on messaging via Facebook Messenger and WhatsApp.
30 seconds left. Your biggest stock call for the next 12 months.
Amazon is our number one pick, followed by Uber. We see rising utility, rising profitability, and as they grow into GAAP profitability, we see a lot of interest in those shares going forward.
Good calls indeed. Thank you for having us to the conference again. Really enjoyed being here. Eric Sheridan, Managing Director at Goldman Sachs. I know you have a busy day on tap. Thank you so much.
Thank you.